Hey guys. All content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. Today we are going to talk about why wages aren't keeping up with inflation. The answers for corporate greed are all correct, but today we are going to be a bit more detailed and surgical in explaining why exactly this is happening. The reason I chose this topic is because it is very contentious and something that a lot of people are talking at the moment. Inflation ran 8.5% as of last month in March, but nominal wages grew only 5.6%, which actually represents a decline in inflation-adjusted wages of 2.7%. This phenomenon has put into question the Fed's rhetoric that a tight labor market leads to rising real wages, something that Jerome Powell has tried to push. Their main idea is that when unemployment rates fall, workers have more leverage to negotiate higher wages, and that job growth benefits not only the newly employed, but those already working hard. There is some highly contested evidence to back this up, mostly by looking at statistical evidence over certain periods that showed real wage growth as categorizing them as pro-cyclical. This evidence has more holes than a brazier's bathroom though. First, the biggest piece of evidence for this belief actually reverts back to comparing wage growth in the 1990s. Wage increases had more to do with productivity growth rather than strong demand. The reality is that labor markets aren't perfectly competitive as the Fed wants it to seem, and workers aren't being compensated based on what they produce, something that can easily be illustrated because modern work's output has risen over the decades but wages have remained flat. Lower unemployment rates have the effect of strengthening the bargaining power of workers to demand higher compensation, but this same strong demand also increases the pricing power of businesses. With so much demand, businesses can charge higher prices. The thing that is put into question here, and where most of the conflict happens, is in the question, what goes up more, the bargaining power of workers or the pricing power of businesses? Evidence collected by economists clearly answered this question recently. The odds are on the side of businesses' ability to mark up prices over costs. A hot economy is good because it brings workers in, but it also has the effect of actually reducing the pay workers get in relation to that increase in power. Businesses have found it possible to maintain wages relatively low in a booming economy, except for the C-suits on top of course, while rising prices, which leads to the sort of inflation and instability we are seeing. I am not saying the problems with current inflation are all wage-based, but the volatility of it certainly has something to do with it. Now that we have a good understanding of what is happening, let's expand on the key reasons wages are not growing in particular to everything else like high profits for businesses. It is scary to think that in the 1960s, people could buy a house for less than 25% their take-home pay while owning multiple cars and putting kids through college. The American dream, however, is not dead, as it is actually continuing to worsen into a nightmare. Income inequality continues to grow rapidly and the only one benefiting here is the stock market. A big reason for this is that companies have elected to start sitting on cash without raising wages. Companies simply do not see employees as an investment anymore, unlike 50 years ago or so. Money is simply generated to appease and enrich shareholders, with little to no care about employees. A reason economists use to explain this is called the sticky wage effect. The theory goes like this: management hates raising wages because once they do, it is hard to drive those wages back down, and in the inevitable time period when the next recession comes or a period where business slows down, they are stuck with a high cost of labor. This is actually a really good explanation because it actually can be easily proven. Recent articles have shown companies are increasing bonuses and benefits, but wages are still remaining flat. A company will be willing to pay $25,000 as a bonus to a diesel electrician but would fight all the way to the courts to raise the base pay by just a couple of hours. Business practices have become quite draconian over the recent years too. Now, through algorithms and tracking software, they measure wage growth for employees while simultaneously measuring performance. If performance isn't continually improving, they start documenting it to use it as grounds for firing the employee. The flaw with this is that one can only ever be so fast, so diligent before it becomes impossible. Companies know this, but have implemented this system because they want to fire employees that stay too long in order to replace them with cheaper labor. As a result of some of these changes by corporate, workers have begun to really struggle. In the year 2018, over 40% of Americans had trouble paying for food, medical care, housing and utilities. Nearly half of Americans have no retirement savings, 63% of Americans do not even have $500 cash on hand to handle an emergency, 70% of college graduates have more than $15,000 in student loans. 4 in 10 Americans have now had to resort to side hustles to help make ends meet, and the list goes on and on. While all of these things are happening, companies are raking in tons of profit, especially the biggest ones, since they, with the help of the Fed, managed to eliminate a lot of the smaller competition during the pandemic. They have taken all the business, and the rich got very freaking rich. Now that we have some of this info, let's move on to the last segment of the video, which will have us take a look and review at wages in the year 2021 so that we can make an informed decision about what is likely to happen for the remainder of this year. Compensation in the year 2021, which also includes benefits like health insurance, showed an increase from September to December, tracking well above expected for nominal growth. There is only one tiny little problem: inflation. Inflation has erased all these so-called gains and deteriorated the spending power of everyone. The outlook for wage growth depends on key factors like the tightness of the labor markets, employers adjusting nominal wage growth up to reflect the higher inflation, and the outlook for inflation itself, which is horrendous to say the least. Wage and salaries grew markedly towards the end of the year, as well as did worker compensation. Measures like quits rate and the number of unemployed workers per job opening did indicate greater levels of tightness. Employment rate continues to indicate modest levels of tightness, while the quits rate suggests the labor market is much tighter than it has been for decades. After inflation slowed down from June to September, it began to accelerate over the last 3 months of the year. Transitory factors like the increase in price for cars have continued to be important contributors to inflation. Increased demand and the microchip shortage both led significant roles in higher inflation. As if this wasn't enough, rent and other shelter costs fastened the pace of inflation. Real wages and compensation grew dramatically during the first 6 months of the pandemic, but began to fall afterwards while price growth accentuated. Real wages fell 4.3% annual rate from September to December. Real compensation has fallen short as well, dipping 1.7% since December of 2019. Though some wages have grown in some sectors, they still remain below trend in most sectors. When we compare the global financial crisis and how they tend to play in the economy while comparing it to the pandemic, we see this recession has been very different. This time, we have had more expansionary policies that supported demand, putting upward pressure on both wages and prices. When hyper-focusing on wages, the patterns for the pandemic and a typical global financial crisis recession are very similar though, and with that, we need to talk about the outlook for this year. Nominal compensation could growth and continue its trend, since the labor market still remains very tight, and at some points, at least some of the price increases have passed on to wages, even if it is by small degrees. Inflation is still believed to be moderating somewhere around summer and then start cooling off. This is almost impossible to predict, because a lot of inflation is now tied with Russia. Russia's conflict with Ukraine has no end in sight, and to make things worse, Russia has begun issuing threats to other countries like Sweden and Finland if they decide to join NATO. If these countries decide to actually join NATO and Russia invades them, that will represent a huge shift for the worse and make the prospects of economic recovery a lot harder to digest for all markets. Inflation at that point is almost 100% likely to pass 10%, and a recession almost impossible to deny. Volatile components like food and energy would then go out of control. If no war happens though, we could see these components return to a more normal increase. As a result, the outlook for wages in the year 2022 is likely to rise, but the rate of growth is already decreasing and begun showing weakness. A new expansion of war could offset this, but inflation will then for sure eat whatever little nominal increase wages see. All in all, companies have found and learned how much they can get away with marking up prices, and though wages are going up, the difference does not offset the new high costs of everything. We know companies are not going to revert to selling at the same prices they did pre-pandemic, so get used to this as being the new normal. Inflation is here to stay as well for the year, so make peace with the 50-cent raise your boss gave you and hope for the best, because right now, you and everyone else is getting slowly squeezed out of purchasing power in America. I hope this video was informative and helpful. I know we covered a lot of material today, but I am super happy I did this one. A lot of talk about inflation and high costs for living are running rampant everywhere. Though the outlook of the situation isn't good, remember that this is not the end and that we will find a way to survive. Stay strong, stay positive, and find motivation. Let me know what you think in the comments below, and that is all I have for you guys. Thank you for making it to the end of the video if you are still here. Be sure to come on over and join the Discord for an even more engaging experience with fellow investors. We have tons of things there, from conversations about GameStop and AMC to day trading alerts, so give it a try. Links will be down in the video description. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day. Keep on buying the dip and to the moon.